looks as if the bonds issue has is a two-way street. It has its advantages and it has its disadvantages.
Yes.
In terms of looking at the disadvantages, for instance, for any reason, there's a major shock in the economy now, and you have to reduce your yield rates or coupon rates, as the case may be. It now becomes a deficit on the part of the issuing country, in this case, Nigeria.
Mm. No, but if there's a shock in the economy, you'd expect that the coupon rate would increase because then the risk increases. Okay, so it will increase. But you see, the thing is that you are borrowing money internationally. And like any borrowing situation, for you to be able to borrow this money, you must have demonstrable capacity. Okay? And so if I'm a company, I'll take this and take it at the local level. I'm a company, I want to go to a bank to borrow some money. The banks don't lend to you except you have excess capacity to repay. And so you find that more often than not, it's like pawnbroking. So they ask you, what collateral do you have?
Yeah, so because I kind of remember when Nigeria issued the Euro bond, the 1 million, was it 1 million, 10 million, 10 billion naira, $10 billion Euro bond. They did a road show for it, and it was oversubscribed 4 times by mostly investors in the US. It actually, began to put the spotlight on Nigeria that yes, we are getting something right. Now that it seems as if we're getting something right, how can we capitalize on it?
Well, what to do is to make sure that those monies are well spent. We're talking about transformation, and we're talking of unemployment. We have issues, we have challenges in this economy. And then what we need to do is that, like I said, borrowing is not the issue in any situation, whatever the context. The thing is that when you borrow that money, how has it been utilized? I think that's what is important. So if this money has been borrowed and we put it where, sometimes you can do, you can borrowing that is going to be self-liquidating. And so you borrow this money and you put it in an investment in a sector that the proceeds from this investment would repay. And you don't start scampering about looking for money to repay when the time comes for you to repay. So for you to borrow, the borrowing itself has lots of positives. It's because, really, if we're talking about transforming this economy, if you want to transform this economy, then you have to be in a hurry to do things. And so to the extent that you cannot leverage only on your internally generated resources. And so it means that really you are going to go out and use other people's money, leverage on it. And to the extent that you are now going to leverage on this money and utilize it very well, that's a massive plus because you're going to bring about development, the pace of development that would not have been possible without you being able to borrow. And so to a large extent, it should be. The downside just comes from the fact that, when this money is misapplied. So that's the issue.
So we should probably be looking at, like for key sectors like agriculture, manufacturing, for instance, we should probably
the real
be looking
sector,
at...
The real sector, like with one of the issues we have in this environment is the fact that unemployment is an issue. So we're talking about the jobless growth. We talked about this sometime on this program. So where you have this situation, what you're looking for is to look for sectors where unemployment would grow. More employment, get more people back working, get them, doing some work. And so if you're going to invest in agriculture or you're going to invest in manufacturing sector in this economy, we're doing about just 5% of our GDP. And that's not, it should be about 24, 25, 26. And you say to yourself, what are the constraints? The constraints are all well known. Part of it, of course, is availability of capital. The cost of capital is also part of it. So you have to borrow money at the rate of 20 to 27%. Then how many businesses can afford to do that? And so you find that those who are able to attract such funding, essentially are those who are going to do trade, so little value addition. So to that extent, you find that when you're talking of growing jobs, that isn't going to happen with such borrowings and with such activity.
So now let's go back to the 2024 bonds, and I'm very sure in the course of the conversation, we'll still come back on the domestic side. Now, this bond, it opened at 12.04% when it was listed, but closed at 11.89%. What does that mean for us?
To a large extent, it means that what you're going to be paying, you're going to be paying less. And so if the thing is, that means it's working in your favor. So if you're going to issue monies and they perform very well, and then the market, the appetite for your debt, for the instruments is still there, then that's a reflection. Now, for most countries that go to the international market, they have to up the coupon rate, because the market, to a large extent, that's a correlation between the risk and the return. And so if the higher the risk, the higher the return. And so when you see that your coupon rate is coming down, to a large extent, it means that the public assessment of the risk that you have within the economy that is reducing. And you know, one thing really that is very reassuring about the Nigerian situation is the fact that, in spite of the problems we have within this economy, the problems we have with problem of insurrection and so on and so forth, particularly insurrection, Nigerian economy to a large extent has remained attractive. And so, if you look at the direct investment flows and you look at the data that is being churned out, and sometimes you step back and you marvel, you know. And we're not talking about just the extractive sector. Yes, the extractive sector, yes, we know that they don't have much of a choice. You know, we have sweet crude, as it were. All right, so they will come to take it, you know, regardless of what is happening. Even if you put it within the fire, you know, if they can get it, they will take it. You know, but you're talking about just the economy itself. And part of the attraction is that really we have a massive economy. You know, the consumer appetite in Nigeria is enormous. You know, I have a very common example. Like, look at ShopRite. ShopRite is a South African company that, you know, merchandises consumer goods, and the number of outlets they've opened. I think last count they were in Ibadan. They even went as far as opening an outlet in Kano. And so you think that in spite of the insurrections, you know, Kano is really like hotbed of this insurrection. They still went there to open a franchise, and this is a private business. They wouldn't go there. So there's something about this economy that, in spite of all, you know, the upheavals and the shortcomings, lack of infrastructure gaps, and so on and so forth, people still find this economy attractive.
But then
companies, hold on, Arad. Companies left Nigeria and went to Accra. So what's happened? They're coming back. Because they went to Accra and discovered that in Accra, there's no market. So you produce it, the environment is there, and the market is here, and you have to produce it there and come back to this place. And so they're coming back saying, wait a minute, it doesn't make economic sense for us to go there and produce and transport back to.
But then it's still you know, begs to reason that in spite of all this seeming status that we're beginning to acquire, we're still the second African country to be listed on this index by JP Morgan.
Well, you know, that's something that beats the imagination. I hope that with this rebasing and so on and so forth, that people begin to see things in true perspective. What just happened before is that all of us were sold on the fact that South Africa is a larger economy. South Africa, by any means, is not. It's not. We are larger than Nigeria. It might be a better organized economy because of the antecedents. You know, no more, no less, but it can't be larger than Nigeria. Everybody knows that. There's no country in Nigeria. Forget about the basin and data, and if you go to the informal sector of this economy, it's massive. All right, so if you look at what goes on outside what we capture in all these indices, you know, we bandy about, it's enormous. The GDP, the things that go on outside the GDP, quite substantial.
Which is what the National Bureau of Statistics is trying to work on, especially in terms of consumption, what Nigerians are consuming
and so on.
At the moment. But then there's some people who actually say that Eurobonds, for instance, are a cheaper option than local debt, and that the Nigerian market does not currently have the required depth and breadth. Do you agree with this?
Well, the Nigerian government is done so well. I did say that we've had 9 outings and raised about $30 billion from the Euro market. And so, well, the Euro market, I don't think it's a market that's really accessible to companies around all over the place. You know, to a large extent, you know, deal with sovereign states and so on and so forth. So, if you could get hard currency, obviously we know the implications in terms of interest rates. If you look at the cost of borrowing overseas and you put that, you align that with what obtains here. So if you're a company and you can raise funds overseas, you are onto a winning streak.